Judgment day is imminent for the banks, with a number of the big banks set to report earnings tomorrow. And investors have hardly been kind to the group in the last 3 months. Goldman Sachs has plunged 13%, while Bank of America and JP Morgan have both dropped 6%. Citigroup also slumped 5% in that time, leaving many hoping that earnings could mark a big bank revival. Leslie Picker's back at headquarters to tell us what we can expect. Hi, Leslie.
Hey, Melissa. That's right. Bank investors are pinning their hopes on earnings for a much-needed boost to their stock prices. We'll see results from JP Morgan, Citigroup, and Wells Fargo tomorrow, with Bank of America, Goldman Sachs, and Morgan Stanley reporting next week. Now, this recent pessimism surrounding the industry has created what analysts consider to be a low bar when it comes to second quarter numbers. Analysts believe that banks simply have to report numbers in line with expectations, with potential surprises to the upside stemming from a recent shift in the yield curve, a potential pickup in loan demand, and a benefit from regulatory reform. One problem spot could actually be mortgage revenue, which analysts expect to decline year over year due to the impact of higher rates. The main reason, though, for some of this recent underperformance, the yield curve, which has spent much of the last few years flattening. Additionally, some investors are concerned that bank earnings have already peaked. Even with pockets of weakness, though, banks could be poised to break out to the upside. The industry is trading at a multiple that's only 2/3 of the S&P 500 multiple, about 8 percentage points below historical levels. Again, it's a very low bar, Melissa.
All right. Thank you, Leslie. Leslie Picker in the newsroom. Our next guest says the banks are looking so bad ahead of earnings, they might actually be worth buying. We're going off the charts with Fundstrat's Robert Sluymer. He's over at the Plasma to break it all down. Hi, Rob.
Hey, Melissa. Thanks very much. So if we're going to talk about banks, we've got to talk about the yield, the 10-year bond yield and yield curve as a starting point. So I think if we look at the 10-year bond yield, remember, banks bottomed back in the first quarter of 2016, ahead of where the 10-year bond yield bottomed. But there's been this sort of stair-step pattern in yields, and now we're over by the 200-day moving average. It's really been in a trading range. That 270 to 265 level, the 40-week or 200-day moving average is at 270. So I think there's actually quite a bit of support for bond yields at this level. Now, the yield curve, the 210 spread at least, has been heading all the way down, heading down through much of 16 and into 17. So that really hasn't provided a lot of support. But the banks have been able to move up higher. So that may not be as important as a lot of people are talking about. Now, when we look at the bank index, it's actually sitting at some fairly important support here as well, right around the 200-day moving average. We highlighted this a couple of weeks ago. The banks are down from those levels, but it's sitting right at the low end of that 2018 trading range. So expectations look very low from a technical standpoint going into earnings. And when we look at this momentum indicator, the RSI, it's not deeply oversold, but it's certainly not overbought in the same way that we saw coming into the beginning of the year. It's sort of neutral. It's around 40, 46 or so. And I think the response here is that we're going to get an upside move in the banks. So let's look at a couple of names, two big names, JP Morgan, and we've seen this pattern before. It trades sideways, catches up to its 200-day, trades sideways, right around the 200-day. I think sentiment is very weak going into these numbers. I think they're at support. The momentum data is trying to hook up. I think it's a positive technical setup. Finally, when we look at Bank of America, same type of pattern, trading sideways over to the 200-day. You see the same thing here, slightly below it. It's not a magic line. It's a general support level. And I think with the banks coming down, along with cyclicals, throughout 2018, there's a pretty optimistic setup from a technical standpoint right here.
Rob, why don't you come on over?
You just asked him. You didn't ask.
I'm tired of asking you guys.
She doesn't ask us anything, but she asked the guest.
Yeah. Rob, why don't you
in
just
Robert's
come
case,
over?
Yeah. You know what? That's good.
I mean,
This is not a democracy. We're
Not right now. It's not.
Yeah. It used to be.
no.
Okay, Robert. So the chart relative to the S&P 500, the banks, was it bank strength or JP Morgan strength relative to the S&P 500?
At the bottom of that chart was the RSI, the momentum indicator.
No, but relative performance to the S&P 500, not the RSI.
That's right. Well, the relative performance of the 500 was not on that chart, but it's been terrible.
Okay.
And it's been terrible since the beginning of 2018, where they peaked, along with many cyclicals, right? If you think about...
That's the chart I was talking about. That's the last one that... Oh, no, that's relative... sorry, that's RSI,
actually,
yeah.
Yeah, so that's just a momentum indicator. But it actually has the very same profile of the relative performance, straight down throughout 2018. And the relative strength to the market has been a lot worse. Now, at these levels... Really, my call is that if you look at this consolidation that we've seen in cyclicals and banks throughout 18, we're 6 months into it. Expectations have come down a long way. If you look at the economic surprise data for the G10, basically peaked in beginning of 18. It's really oversold and starting to hook up. Now, it doesn't necessarily mean yields are going to scream to the upside from here, but I do think that the sentiment for cyclicals for banks in general is a little bit overdone at these levels. I think these stocks pop in earnings.
So, Robert, you're looking at a lot of large cap banks that might be in the ETF XLF. What about the regional banks, KRE? Do you look at those? To my eye, they look a little weaker than the big caps.
Well, today they certainly looked a lot weaker, and maybe sort of this week. But in general, I actually think the chart looks better. If you look at the relative performance of the KRE to the BKX throughout 18, it's actually held in much better. So I actually think the regionals have better selective, but better looking technical profiles. Many of these names have gone over their 200-day moving average and are starting to accelerate.
All right, Rob, thank you. Rob Sluymer of Fundstrat. What are you looking for tomorrow morning?
Hopefully green. It's Judgment Day. It's Judgment Day for my portfolio as well. I have big exposure to all of them. Tomorrow only we're going to see JP Morgan, but that should give us some insight into a lot of different things. Loan growth, talked about it a lot, and then capital markets as well. So for me, though, Citi represents the biggest upside potential. But I'm long all three, Citi, Bank of America, JP Morgan.
Look, I think it's going to be a moderate quarter, but I think for most of these guys, JP Morgan's going to mean record profits. Loan syndication growth is best it's been since 2007. You've got M&A, as Karen pointed out, which for 2 quarters in a row has been very strong. And the net interest margins, folks, continue to eke higher. But the most important thing is valuations at 9.9 times. You're at the bottom of a historical range. Absolute bottom. Is that fair in this environment?
Were the bank earnings last quarter pretty decent?
They were decent. They were all decent.
And
the
they didn't
price
trade
action
well.
was miserable.
Yeah.
And that's been the case for quite some time.
But they ran into those earnings.
They did run into those earnings.
Yeah.
But then we didn't bring this up, but Dan Nathan has, and I talked about it a while back. XLF, you're a technician out there, armchair technician, you want to play the game? Pull up an XLF chart and go back to 07, look where it topped out, and look where it topped out earlier this year, basically 30.5. That's not particularly good. But JP Morgan, I think, will be strong. What I look at is price to book. Price to book last quarter, JP Morgan, 67.5-ish, closer to 69. That's a good sign. What's the right multiple on that? I say at least 1.5, and you have a $125 stock.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.